Hi there, and welcome to the first Abu Dhabi Bank Global Investment Outlook. This is the quarterly update, and I'm thrilled to be joined by Simon Ballard, Chief Economist at First Abu Dhabi Bank. Simon, great to see you again. Thanks for coming.
Thank you, James. Great to be back.
Let's get stuck in. So tell me, where are we with the global macro story? Because if you look at Q2 2020, the lows, and you look at where we are now, what are the future growth expectations? And if you give me the Ballard breakdown, that would be great.
No, of course. And when we spoke earlier in the year, of course, we were talking about the rebound from the lows of 2020. And obviously we saw that from a 6% recession here in the GCC, a 3% global recession. We rebounded in 2021, and then we've got obviously the continued rebound through 2022. We've had the added complication, of course, of geopolitical risk with the conflict in Ukraine, Russia, the inflation impact that has brought through food and energy prices, the consequent tightening bias that we've seen from central banks, led by the Bank of England initially last December through the Federal Reserve. The impact that that's had on a slower growth environment is clearly bringing down expectations for global growth in its entirety this year. We've seen the IMF, the World Bank, reduce their expectations by about 50%, in line with our own view that growth is going to come down from 6% to around 3.6 to 3.4%. This year and over the next couple of years. So in a slower growth, sticky inflation environment. The S word, of course, is looming large for later in this year, perhaps. Stagflation, possibly recession, and possibly then for the longer term story is when does policy reversal start to kick in from tightening through to easing? But that, of course, is a question for later.
You mentioned easing, so central banks are trying to ease inflation by increasing interest rates. So are they going to be successful?
Well, there's the big question. If you look at the data at the moment, clearly not. One of the arguments, of course, is that our arguments, of course, is that inflation is interest rate insensitive to a certain extent. If we look at what the key drivers of inflation have been during the course of this year, it's been predominantly food and energy through the conflict in Ukraine. That is not something that's going to be addressed or brought down or tamed by increasing interest rates. The Federal Reserve has hiked rates 150 basis points since March. The Bank of England has tightened policy by 115 basis points since December of last year. The ECB is about to kick off in July. Now, the ECB is the most dovish of the lot. Theoretically, we thought we'd push it out to the end of the year or early next year. They've effectively rubber-stamped a rate increase in July and possibly a larger 50 basis point move in August. Inflation is still remaining high. So the short-term answer really is no, they're not bringing down inflation. They're slowing global growth. They're slowing the underlying fundamental metrics. That's where that stagflation story starts to pick up momentum in a greater number of listeners.
So you mentioned interest rate hikes, which are pending. When would the Fed ever consider or flirt with cutting back rates or rates going lower?
Well, this is very much something that I think the market is starting to price in and will increasingly price in over the next couple of quarters. We've got further tightening to come between now and the end of the year. The peak in monetary policy tightening is probably in Q1, Q2 of next year, as the market sees it at the moment. I think that's a policy mistake, and I think in actual fact we'll see that being dialed down during the latter half of this year as growth metrics continue to weaken against the backdrop of higher interest rates. But I think overall you will start to see a Federal Reserve, Bank of England that is increasingly more open to data dependency. It'll talk about being more cognizant of the underlying macro environment against which it's continuing to tighten policy and chase inflation. It'll see inflation starting to peak, stabilize, plateau, whatever you want to call it, rather than decline significantly. And I think at that point, we're going to start pricing in probably stagflation, as I say, for the end of this year, potential recession during 2023, and perhaps the first shift to a downward, a looser policy bias in Q3, Q4 of next year. Q1 of 2024 is when we believe that the Fed will be reducing rates into a recessionary environment. Okay,
so you've mentioned stagflation quite a few times, and I'd like to just go back maybe to the start of this month where you released a very interesting report. It was entitled A Global Sweet Spot. So it was covering the GCC, the countries, those member states. If you're looking at fiscal deficits, you talk about stagflation, high oil prices. Do you still believe this is a sweet spot?
No, absolutely. I think that's a great question. The report we wrote was looking, as you say, at stagflation. Clearly, in this region, inflation isn't as much an issue as it is in the US and in Europe. For first obvious reason is the fact that the monetary stimulus, the expansion of the monetary base that they've had in the US and in Europe has driven price escalation, which we haven't had in this region to a certain extent. But given the underlying strength and expectation that oil prices will remain buoyant going forward, that's helping to address, the deficit reduction. Saudi will return to government budget surplus for the first time in 10 years this year. The UAE will return to budget surplus for the first time since 2019 this year. So the underlying fundamentals, the sovereign credit quality that you see in this region against a backdrop of a weakening macro picture in the US, Europe, the UK, I think continues to shine in terms of the the relative allure of the GCC. We've had a rebound from, as I said, from 6% recession in 2020, 3% positive growth, real GDP growth in 2021. We're probably going to get to around 6% GDP growth on average between the UAE and Saudi this year. That will then taper off to around sort of 4.5%, 5% in 2023, 2024. But I think, increasingly against the backdrop of macro uncertainty, particularly with this question about, when the Fed will have to reverse policy and move into an easing bias as the labor market is, the labor market in the US is where, the Fed needs to find the slack. So a deteriorating labor market as rates tighten over the course of the next 6, 8, 12 months. I think again we'll shift the focus more favourably again onto this region as it should.
Right. You mentioned macro uncertainty, so let's talk about macro. Let's talk about emerging market macro and in particular GCC macro. How does that fare compared to the US and Europe, for that matter, over the next forthcoming months?
No, I think as per our earlier comments, the weakening of the global macro picture driven by the US and Europe again helps to accentuate the underlying strength that we're seeing here in the MENA space. And I think even within the EM basket, the MENA risk part of that basket will outperform over the course of the next 12 months. So I think from a fundamental sovereign credit risk perspective, in terms of supporting the single A ratings in Saudi, the double A ratings here in the UAE, versus the volatility, uncertainty, cost of living crises in Europe and the US. Again, the macro picture here looks robust. As I said, we're seeing deficit reductions, which I think is key to sentiment going forward as well. And as long as the oil price remains around the sort of $100, $110 a barrel or higher perhaps, then that's a great positive for government revenues, for the government balance sheets, and basically just for sovereign credit quality in this region going forward. So GCC producers are in a really strong position, I think, at the moment relative to the volatility and uncertainty weakness that we're seeing elsewhere in the world.
Correct. Last question. You mentioned the S word. We've mentioned inflation. Putting that aside, what keeps you up at night?
I guess one of the main things to keep you up at night will be the overreaction by central banks. Again, I'm afraid it's to do with the S word and the R word. But if we do see the Fed continuing to talk about taking rates into restrictive territory, by continuing about tightening policy regardless of the underlying weakening fundamentals in order to get on top of inflation, I think what keeps me awake is the fact that they continue to not recognize the fact that there is an interest rate insensitivity to current inflation pressures in the world. So apart from that, or perhaps a complete reversal in the sort of what we hope is sort of a stabilization and a future sort of improvement in the geopolitical situation in Ukraine, then of course that would be enough to keep everybody awake at night and would be a significant negative impact on the global macro picture. And finally on China, I mean obviously we've heard recently about sort of the relaxation of COVID-19 protocols, the extension or the easing of quarantine. If Xi were to go back to a full zero COVID policy, and he's said recently that he still supports the zero COVID policy or COVID zero policy. If he were to adamantly go back to that and strictly so, then I think that would keep me awake at night in terms of the negative impact. After all, sort of the slow, steady improvements that we're seeing on the global macro front, that would obviously impact that from a negative perspective and change our outlook for the second half of the year, early part of 2023.
Yeah, correct. Always insightful, always informative. Thank you so much, Simon Ballard. See you again soon.
Thank you.
Thank you.